We are live now.
Okay, welcome back, everyone. Good afternoon. We are ready for our next section. We will begin now with Martino Grasselli. I hope I had pronounced it well.
Perfectly.
Close enough. Within an epsilon of the correct pronunciation. Zubel asked me also to once more acknowledge the support of Demo Investments, and we're happy to have you all here. So Martino, please go ahead. Thank you. He will talk about SMILE modeling for exchange-traded products on future strategies.
Thank you very much for the introduction. Of course, I would like to thank George, Marco, and Bruno for the kind invitation. It's a pleasure to be here. Of course, it would be better to be there near Rio, but okay, we will see for the future. And of course, I would like to mention also the inspiring works of Marco. Even if we didn't have so many occasions to cross each other, I took a lot of inspiration from his works. And in particular, the paper we are presenting today is a joint work with my PhD student, Andrea Mazzoran, and Andrea Pallavicini from IMPA and Imperial College. Is a work that will be appreciated in particular by Marco, because I know that he's quite fun on trading notes, in particular the VXX and other products on volatility. And also would be of interest for George and Bruno, since the approach we try to tackle this time is based on local volatility models. Okay, so first of all, what does it mean, volatility products? So in the last years, of course, there is a huge increase in demand for volatility instruments. And in particular, the VIX that I will introduce later a bit more and more precisely, it is now considered as a benchmark instrument for monitoring and trading volatility. So what does it mean, trading volatility? We can summarize all the concepts involving trading volatility by saying that it's just a question of implementing some equity and option strategies in order to take profit of market variability. So we have to introduce the notion of market volatility now. There are many possibilities to introduce something which is traded in the market concerning volatility. The first one is based on realized volatility, and the other one in terms of the options or derivative products. So we speak about implied volatility. So here I brutally borrowed a scheme from Bruno Dupuir, who is very clear. And we see that the family of volatility products is very, very rich. In particular, we have some underlying. So, for example, based on the S&P, we have some products on the S&P directly, like futures and options of the S&P, but also on the corresponding implied volatility. So the VIX index, which is not traded, we will see, and products on the VIX, so futures, options, etc., etc. And now, lastly, there are some particular recent products denominated as exchange traded notes, which is VXX and other different declinations of this product. So there are many possibilities to trade a volatility market based on realized, implied volatility, and there are also strategies involving implied versus realized, so going long and short, etc., etc. There are also correlation products, implied correlation, dispersion strategies. You can really can implement many strategies based on volatility. So we start with the notion of historical variance, which is well investigated, also well explained in the previous talks. For the OTC market, we can have some volatility swap, which just two private counterparts, variance swaps, corridor variance swaps, and options, etc., etc. There are also some official listed products, for example, futures on relative volatility and options on relative variance. So for the here there is something missing. Okay, so the notion of implied volatility, of course, comes back from the Black-Scholes formula, the wrong parameter to put into the wrong formula in order to get the correct price, which is the quoted price of the option. And there was an index introduced in 1993 in Chicago, and modified since 2000 in order to take into account for the skew of S&P options. And nowadays, VIX is really gives the temperature of the fair gauge in the market. So just to mention quite quickly, because we are just on the preliminaries now, the new definition of VIX after 2000 takes into account the possibility to consider also the skews in the option market. So we can take a portfolio involving two maturities of OTM options, and the objective is just to take a combination in order to track the 30 days implied volatility. So we see that the behavior of the VIX is quite active. This is just a historical series. We saw not only during the last crisis, but also very recently, the peak of the VIX reached very considerable values. And just to come back to the very definition of the VIX, it cannot be traded directly. So since 2006, there has been the introduction. 2009, there has been the introduction of some ETNs on VIX, which tries to mimic the behavior of the VIX future of the first month. So the first maturing VIX future. We'll see the correct definition later on. Okay, so there is a natural negative correlation between the S&P and the corresponding implied volatility, so which is reflected also by the behavior of the VIX, and this is empirically well established, and this is also in terms of historical series. And there are typical behavior of the futures on the VIX. So in particular, that you can observe during the last financial history some periods where the curve was increasing, so in contango, decreasing, backwardation, and also some humped behavior. So here, for example, there was in contango, so the time structure of the feature is increasing. So typically after a financial crisis, there is the possibility to have a backwardation behavior in the future. And there is also, for example, in 2009, some humped position in the curve. So just to say that in order to introduce a model which describes these effects of the VIX, of course, we have to consider the possibility to have a flexible model in order to take into account these features, which are basically more or less the same as in any interest rate model, etc., etc. Okay, this is a historical series of what happened till 2010. We can, of course, update, but basically the situation is qualitatively similar. Okay, so the problem is not really a problem, it's just a constraint, a limitation. We have a larger denomination, so it is typically difficult to take position for the small investor in the VIX market, in the VIX futures. So there is a demand of taking something cheaper, basically, which behaves more or less in the same way as in the VIX, but possibly more accessible for small investors. This is just a quick look of the VIX implied volatility. So there is an active option market on the VIX, and typically the SMILE is increasing, contrary, of course, to the behavior of the SMILE on the S&P. And as I told before, since 2009, Barclays introduced the first ETN on the VIX. So there are some different notations according to the fact that you want to mimic the behavior of the first maturing 1 month future, or the second, third month, etc., etc. So we have some notations like, for example, VX6, VXZ, etc., etc. There are some of the other notations also in the sequel. So the contrary to the ETF, an ETN, so exchange traded note, is linked to the debt. So in the sense that it is linked to the credit score of the issuer. So in particular, it is considered as a credit risk product, and there are also some constraint on the redemption at the end. On top of that, we can say that it is not really related to the basket of assets like in ETF. Here, we really try to replicate the strategy using quoted products. So VX6 provides a daily rolling long position in the first and second months VIX futures contracts, according to the prospectus provided by Barclays. Okay, so these are an overview of all the products issued by different investment banks. I go quite quickly here because there are all these things are quite okay, just a question of notation. Here, so I took from the prospectus of Barclays the definition of the VX6, which I stated here in the formula. I see that the return in discrete time, but of course we can easily generalize continuous time. In discrete time, the return of the VX6 is related, as you see in the numerator on the right-hand side, the expression is related to a position involving two coefficients, A1 and AT. So a convex combination involving the return of the two futures according to the maturity T1 and T2. So the definition of the return of X6 involves a nonlinear expression of futures, of the first and second futures. This is quite indicative to the fact that even if you choose, for example, a flexible, analytically tractable model to describe the evolution of the VX and accordingly to the possibility to have some nice expression for the future on the VX, of course, due to this formula, to the definition, of course, you see immediately that you break down immediately the analytical tractability for the corresponding VX6 product. So even if, just to take an example, you consider a fine, very analytical framework for the VX, unfortunately, you deal with the problem of pricing a product which is quite complicated from the analytical point of view. Okay, so A is a rolling factor, and basically you see that according to the fact that you're approaching the maturity of the first expiring future, you put more weight on the second future in order to mimic the behavior of the first expiring 1 month future. That's the idea. And thanks to also the possibility to have a very small amount in this kind of market, of course, this is very well preferred to position on VIX futures, and the counter have a great success from the beginning. So there is a very active market on the VX6 together with option market on the VX6. We see that the relation between VIX and VX6 is I mean, they are positive correlated. The correlation is very high here. And there is a pathological dependence on the fact that there is an underperformance of the VX6 with respect to the return on the VIX in the case where the future time structure is increasing. So in the case where the future time structure is in contango, the idea is that due to the formula, typically you put more weight into the future with longer maturity, which is typically more expensive. So you have typically in the contango situation an underperformance of the VX6. Of course, the opposite holds true in the backwardation. But what historically you face is this behavior to the point that in the red curve corresponding to the VX6 return, they were obliged to split 4 times during the last time series the VX6 in order to avoid that the VX6 return reached 0. So it was typically in contango, but sometimes when there is an inversion of this tendency, you can have really a overperformance up to 300% in the case of backwardation. So the behavior is quite similar. Okay, so these are more or less the steady effects. And the idea is that, okay, are we able to provide a consistent framework in order to describe jointly the dynamics of the underlyings together with the corresponding option price or implied volatility surfaces? But you can tackle the problem from the very general point of view, so including also the S&P, so the very underlying, or just to limit yourself to the volatility market. So in the case of the wall-consistent joint approach, it is too ambitious. It was firstly attacked by different persons, but not involving S&P, VIX, and VX6. So what you typically denote with a joint approach involves the joint calibration of S&P and VIX. We also hear some talks on that. But here we deal with the problem of just try to understand what happens in terms of VIX and VX6 together. Okay, this is a list of papers involving the joint approaches, so the possibility to the standalone approaches, so the possibility to write the dynamics on the VIX and just to deduce the corresponding dynamics of the options on the VIX and VX6. Not so much literature involving VX6, a lot of literature on the standalone approach on the VIX market. And as well, for the joint approach involving S&P and VIX, there is a huge list of papers dealing with that. Okay, so we now deal with the problem of considering VIX together with VX6 market here. So a couple of years ago, I considered the problem by looking at the VIX as in some sense commodity asset, in the sense that there is no constraint due to martingale or no arbitrage, since it is not traded. So you can have a degree of freedom by describing the evolution dynamics of the VIX. So you can just borrow the models coming from the commodity market, where there is a convenience yield or something like stochastic dividend yield in the drift, and try to understand if you're able to impose a martingale, so no arbitrage condition, when you just speak about quoted prices, like, for example, futures, etc., etc. So this was the approach developed with Lakshit Vagala, now appeared in ISTAF, International Journal of Theoretical and Applied Finance, where we consider the underlying process X, which is the basic risk factor involved in the dynamics of the VIX, denoted by S. Sorry for the notation, because typically S is devoted for the dynamics of the S&P. There is no S&P in the story, just the VIX. So the idea is that, okay, we have an affine framework in order to describe the VIX. With this affine framework, of course, it is very simple to find out explicitly the closed form expression for the futures on the VIX. So we are able to find explicitly modulo Fourier transform, Fourier inversion, the prices on options on the VIX. And we can represent easily all the stylized effects in this market, because we are able to reproduce contango, backwardation, also hampered the behavior of the VIX futures, no problems on that. And it is that we can recover the dynamics of the VX6 in terms of the dynamics of this affine process as well. But here we have to stop, in the sense that, analytically speaking, we are not able to go further, to go ahead with an analytical approach. So here, the exercise was just to say, just to look at what happens if we calibrate on the VIX market, cross our fingers and try to deduce out of sample which is the corresponding implied volatility generated by the calibrated model in terms of the smile of the VX6. So it is a completely out of sample exercise. Is this framework able and flexible enough in order to reproduce also some insights in terms of the implied volatility surface of the VX6? I just anticipate that it is an hopeless problem, in the sense that since the dynamics of the VX6, it is a nonlinear transformation of the dynamics of the future on the VIX, we can think about the VX6 like an exotic, in the sense that it is a path-dependent product in terms of the VIX futures. And of course, if you fit the market just looking at what happens in terms of the vanillas on the VIX, it is the long-standing problem to deduce some information on exotics just looking at what happens in terms of vanillas. That's the idea. So we know already ex ante that it will be very, very hard to find more or less some consistency and coherent results without introducing an additional constraint on the dynamics. Okay, but what we see is that if we fit, if you calibrate with standard methodologies, the VIX market, and here the fit is not so bad, think about that we are a purely stochastic volatility model here, and very simple. So we can deduce the corresponding implied volatility and the difference with respect to the market, which is not so scarce, is not so bad. Of course, it's not a calibration, it's just a production of the corresponding smile, but so just to understand what is able to do a purely stochastic volatility model. So we're partially satisfied, of course, not fully satisfied. There is still some difference in the in the implied volatility of the VX6. But what is remarkable is that we are able to deduce something completely out of sample. So we are just crossing our fingers and try to see what happens. Okay, so also in a case of a backwardation, we repeated the same exercise, and the results were quite satisfactory, but of course not perfect. Okay, so these are the limitations of a stochastic volatility approach. Now, finally, we decided to sophisticate a bit more the model in order to allow for local volatility also in the dynamics of the VIX. So here we develop a general framework in order to deal with generic exchange trade strategies, portfolios, not necessarily only the VX6, but of course in our mind there is the focus on the VX6. So this is the dynamics of the generic strategy. Put in mind, of course, the VX6 example, where the summation stops at capital N equal to 2. We consider just 2 futures. And the idea is that, okay, if we start from the future and we suppose to get to start with a local volatility function nu of the VIX, possibly driven by a multidimensional Brownian motion. Here we have, in principle, that the dynamics involves many sources of risk, and of course, the idea is that we have to work with some local volatility calibrator. So you have to merge into a one-dimensional problem, and the most natural way to do that, of course, is to project according to the Markovian projection. So just a small recall for the Guillaume lemma. If you have a process, you can just project into a one-dimensional problem which has the same one-dimensional distribution as the original process, and it involves some conditional expectation that can be computed quite efficiently, and we will spend a word later on if we have time. I don't guess. So the idea, just to take an example, if you take the simple stochastic Hellstone model, this is not, of course, a Markovian in one dimension, in the dimension of the underlying, but you can take the Markovian projection and project into a one-dimensional process Y, which has exactly the same one-dimensional distribution of the original process. Of course, you are losing some information, but at least you can deal with the methodology which applies in the one-dimensional case. Okay, so coming back to our problem, we have a Markovian projection for the future prices. So we denote by eta f, the local volatility function in this case, which is one-dimensional, involving all the information of the future prices. And we can also introduce the local volatility function for the corresponding strategy. So eta v for the VX6, just to think about it, this is involving the weights defined by the strategies omega and the local volatility functions of the futures. Here, the idea is that, okay, we have a one-dimensional problem for the VX6, one-dimensional problem for the VIX, so we can apply the local volatility model for both of them in order to calibrate to the corresponding implied volatility surfaces. But of course, we have to relate each other. So which is the relation linking the one-dimensional Markovian projection eta f with the one-dimensional projection eta v. And here we have some degree of freedom, of course. We can choose, for example, we can choose a simple specification or a richer specification according to the quality of the fit ex post. So the aim here is to provide a flexible approach in order to be able to calibrate both models. That's the idea. So we are not performing for the moment a calibration, but we are just suggesting a cocktail of parameters which are compatible with the joint calibration. In which sense? So in the sense that first we calibrate on the VIX market. In order to do that, there are standard procedures. So we introduce the future prices, and we are able to apply standard methodologies in order to calibrate on the VIX market. So we have here a cocktail of, we can say, calibrated parameters. Then we relate the local volatility function of the futures to the local volatility function of the VX6 according to this formula. And this formula 13 is simply says that we need a function relating the vanilla with the exotic. This function that we can denote with local correlation function, in principle, is quite complicated function. So capital R could involve the whole information structure on the VX6 itself. And for the moment, the process V, which corresponds to the presence of an eventual stochastic volatility factor, you can put V equal to 1, and you come back to the pure local volatility framework. But unfortunately, this simple framework is not enough in order to generate compatible prices. In other words, we need a truly full local stochastic volatility model in order to be able to calibrate consistently VIX and VX6. This is not surprising because, as I told before, you need a more degree of freedom in order to connect a vanilla with an exotic. Okay, so we can deduce the corresponding form of the local volatility function of the VX6, and we provide a simple example in the case of VX6 where just we need the two futures. So we decompose the correlation matrix into the Cholesky decomposition if you want. So we parameterize the local correlation vector in terms of just one correlation function, which is denoted by rho. And now the challenging point is that rho, which can be easily related to the local volatility functions of VIX and VX6, now should be calibrated in such a way that it always lies in the interval between -1 and 1, because indeed it has the meaning of correlation. So the idea is that are we able to provide a cocktail of parameters which are able to calibrate to fit the VIX smile, the VX6 smile, and which is admissible in the sense that it leads to a correlation function rho which always lies between -1 and 1. This is the challenge. And the challenge, so just I mentioned, since this expression involves many times the computation of conditional expectation. For example, we follow the approach of Julien Gouillon and Henri Labordère in order to compute the conditional expectation. But I mean, this is just quite standard routine nowadays. And we look at, in the remaining minute I have, what happens in terms of the performance of the market. So we took a book of options. Just a word about the VIX market. As you can see here, the spread are not very, very smooth in the sense that, I mean, if you look at the VIX option market, you should need some regularizing smoothing techniques, like, for example, the SVI techniques of Jacquier and Gatteral and Jim. So you can regularize the curve in order to be consistent with no arbitrage and try to make smooth these prices. So for the VIX market, maybe it is the case to do that. For the VX6, is not really the case because it is already regular enough, as you look at in this picture. So even if you apply SVI, is not really necessary. But what about the performance of the fit? And these are the last slides. So we are able to provide a cocktail of parameters in such a way that the fit of the VIX is perfect, which is not surprising because any local volatility model is able to perfectly calibrate on the VIX itself. But what is nice is that you are also able to reproduce very well the dynamics of the VX6. And I repeat, we just provided a cocktail of parameters because so far is not a global optimization. But if you are able to provide a cocktail of parameters which is compatible and flexible enough, of course, now we have a framework in order to introduce an optimization base. For example, I mean, I guess that the most natural candidate is a machine learning technique here. So just to summarize, if you just attack the problem by considering a stochastic volatility approach, of course, the fit is not satisfactory. With a pure local volatility, I mean, is rich but not enough. So as well, is not flexible enough. We really need a stochastic local volatility framework in order to be able to fit both markets. Of course, there is a lot of empirical and other theoretical points are not clear, but we have no time here to develop these things. Thank you for your attention. I think that it was almost on time.
Great. Thank you, Martino. Great talk. I have a question while I wait if someone has another question. So when some times of crisis arrive, I mean, we
Yes.
had a couple of times in the past. I agree. I think that the volatility increases a lot, right? So how is the behavior of your model in this case when you have crisis? And in particular, you can also discuss if the or maybe this could be a related question, but a different one. If after the pandemic, you had seen any change in behavior of these markets, the volatility market.
Okay, so I think that your question is more related to a time series analysis more than calibration, cross-section calibration perspective. What we can say so far up to our empirical investigation is which is the impact of an increase of the corresponding factors, for example, an increase of volatility during the crisis, etc., etc. But unfortunately, so far, we have not so many elements in order to give you a satisfactory answer, in the sense that we just limited ourselves to consider a couple of dates in cross-section perspective. So if you want, your question belongs to the empirical investigation to be performed.
Okay, great. Have you explored also any kind of high frequency trading strategies related to this, or is there any?
No, so far, no high frequency trading. No, it was just an option pricing perspective. So a book with some horizons, etc., etc.
Okay.
There
Great.
could be many other things you can introduce, additional ingredients. For example, I mean, we have a quite standard diffusion process. We can sophisticate things by including jumps, by including roughness, by including what you want, basically. But first of all, in my opinion, with simple models, as suggested by Chris yesterday, it should be simple but not simpler. The idea is that we start with this framework, which is unmissable, and then we can, of course, add additional ingredients.
Yeah, great. Very nice. There's a question here by Julian Guyon. What are the empirical values of the correlation rho?
Okay, rho is a function, is not a parameter here, and the correlation varies, but for the moment, the important thing for us was a sanity check in order to test if there is some violation of the constraint between -1 and 1. And sometimes for certain omega, I mean, we were very close to the boundary. What does it mean? It means that the framework is flexible, but we are maybe bending the constraint. So, I mean, there is also some study to be performed here in order to understand if the specification we suggested is the best one, or maybe you can, for example, decompose in a different way with respect to the Cholesky decomposition.
Okay, there are two more questions, and I'll cut to go to Alberto. So Sergey saying, did you look at regime switching? Do you think that may improve this fits further, but still remain tractable? And the other one along the same line of reasoning, did VIX or VXX futures happen to provide early warning signals of forthcoming instability?
For regime switching, I can answer very quickly. If it can remain tractable exactly as any local volatility model where you introduce regime switching. So it depends on the way in which you introduce regime switching, of course, because you have to solve the corresponding PDE, solving the Bruno Dupuy equation, etc., etc. I forgot to say, of course, at the very end, thank to everybody, happy birthday to Marco, but every year I remember that also Bruno has a birthday. I don't remember exactly the day but okay.
With an epsilon.
Yeah, with an epsilon,
great,
with respect to Marco once.
Okay, thank you very much.
I stop my sharing here.
Yes, please. And then we go for Alberto.